All right, welcome everyone. This is Saturdays with Eddie. Today is Saturday, May the 4th. May the 4th be with you, huh? Quite interesting. I haven't actually watched the Star Wars thing. Big shock, isn't it? I don't know. But anyway, yep. So yeah, this is a forum where we come together every couple weeks, give or take, just to check out what's happening in the options world and uh, get ideas. So we build an agenda as we go along, depending on who's available in the audience. So I think based on what I see, I think maybe half of you know what options are. I'm not too so sure about perpetual. Perpetual, where are you coming from in terms of options trading experience? Where are you at?
I'm a novice.
You're a novice, okay? All right. So you're still learning and all that.
Yes.
Anything you're stuck on that we can help you get unstuck?
Anything I can know, I'm just a novice.
Okay. All
Thank
right.
you.
That's cool. That's cool. Well, feel free to ask questions. If you have any trades that you want us to look at, or strategies that you're struggling with, we can probably take a look and see how we can help.
Thank you.
You're welcome, Anthony. Welcome.
Morning.
Good. What's
Morning,
happening?
everyone.
It's a Saturday, man. Took you away from the golf course there, man.
Were you losing?
No, no, no. I haven't left the house. I'm saying
Oh,
I took
okay.
I, I took you away from the golf course.
Oh no, it's raining here.
Oh, okay. Well, in that case, you're in the right place. So
Always.
very cool. Very cool. All right. Doesn't seem maybe the link got out too late. I'm not too sure, but I'm not too worried about that. I plan to have a really short one today if I can. But is there what's on your all's minds talk about? Do you have any hot topics you're thinking about?
I have a question for you, Eddie.
Sure, of course.
And it's going back to what I was talking about yesterday with the iron condor.
Mm-hmm.
Now I'm in my sim,
Yeah.
but and I and I had difficulty getting out of the trade, but ultimately it just expired worthless.
Okay.
So
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 you
I
kept
I
all
took right, but I don't want to do it that way. I want to get out when I want to get out.
okay.
Is there, let's say I'm in my live,
Mm-hmm.
is there an easy way of getting out of an iron condor when you're in profit and you want to get out?
There is an well, I don't know whether it's easy or not, but there is a way to get out of your iron condor. And I've been doing condors also lately. So there's two parts of a condor. There's the PCS and there's the CCS, right? On,
Right,
on both sides of the aisle, if you will.
right.
And usually, if the price is right in the middle, you're good, right? You're good. Prices are shrinking as the day goes on and all that. But sometimes you find that one is basically worthless. It goes to worthless, and then the other one is still holding some value. Or you want to just get rid of the one that is in a precarious state. So with an iron condor, the good thing is that you can actually close one side. Instead of closing the
Okay.
whole structure,
All
you
right.
can close one side.
All
So
right. I was wondering about that.
yeah, so you have to be careful about which side you want to close. You don't want to close the winning side. You want to close the losing side. That's the better
Right.
way. Yeah.
Well, both sides were winning,
Hmm.
but it was just one side was getting close. And actually, ultimately, it never really got as close as I thought it was going to get.
Yeah.
But yeah,
Okay.
that's what I was thinking I should just go ahead and close out one side, but I was
Right.
like, nah, let me just leave it.
Yeah.
I'll leave it.
Yeah. There's definitely a way to close that. Wonder whether I can actually simulate uh, that scenario. Do you know how to figure out how much it costs you on each side of the trade?
Yes.
Okay, so that's for those that might not know, you just need to go over to the monitor side, and then you would look in your positions detail, and you'd have to do some math this time. to figure out, because by default you get information about the whole thing, how much it costs you, and that may not break down what each side costs. There's usually one expensive side, one less expensive side. Set up my system over here to see whether we can do that. So yeah, when I'm evaluating even closing one side, so let's take an example here. Theoretically, we purchase, or rather we sell an iron condor. Gotta pick some figures here. Clear my drawing set. Okay, let's go on demand. I'm just going to go with some odd numbers here. Where are we at today in terms of SPX? We're at 5127, and I'm assuming this was SPX, right, Anthony?
No, I did it on equities. I did this one. The one I had trouble getting out of was AMD.
Okay. And hopefully they were far enough. You were far enough on that AMD.
Oh yeah.
Yeah. Okay. Yeah. The thing about equities and selling premium is that there's two things. There's the pin risk, and there's actually that's just it. Pin risk of being exercised prematurely, which throws a lot of people off, and then they don't know what to do. But most, the brokers are pretty good these days. They will close out both sides for you. Might even charge you a little bit, but that's okay. So let's see if I can the day I sold. What was it yesterday? Could be yesterday. Yeah. When we trade so much, you forget what you traded, right?
Yeah.
We're in May, and looks like we cannot get today's May the 4th. Today's May the 4th. I'll just go to Wednesday. How about that? Just go to Wednesday and go. I'm bringing up my on demand to see if I can make some sort of example. All right, that's good enough. Cool. So hopefully you can see my screen here.
Yes.
And I am showing. I'm showing what SPX here on the SPX on the daily, and current price here is 5020. So if you were to do an iron condor, I'm going to do an example here on the on the SPX as opposed to AMD. And I believe price is moving at this time. So if we go here I'm going to zoom in. First check a couple of things. I'm going to check for IV. I don't know whether I have any IV available on demand. Don't have any IV data. So that's always a problem. Yeah, no IV data. So we're just going to make some estimates. Let's say you believed that price of S&P is not going to go above 5040, not going to go below 5,000, and you're creating your condor here, a channel, right? So you want to pin maybe the 50-20. So I might choose to sell, and this is for example only. So I might choose to sell the 49.95 5,000, and also sell the 50-40. Yeah, are you done? Okay. Yeah, that's okay. Cool. All right. And also sell, what am I going to sell here? The 50-40, 45. So let's see how that works. So that's a really high premium to collect on that iron condor. That might be the reason why you might want to do that. So I'm just going to confirm and send here. And I'm not going to do anything fancy. So we got filled at what, $3.30? So 330 is a high premium for a condo. And that's great. So you notice in my position statement here, then I do have this column for trade price, but I want to find out of that $3.30, how much did I actually sell each side for? And the reason I want to know that is so that if one of them starts to lose uh, or do something funny, I want to know how much would I buy it back for so that I don't end up making a loss, in fact. So what I would do is I would look into this trade column, make sure that I get the correct ones. So here I want to look at the, say the 50, 40, 45. So I'm interested in these on the call side. I want to subtract the one that I went long from the one I went short. So 1095 minus 945. See what that is. 10.95 minus 9.45. That would give me $1.50. So you can see that I sold the call side for $1.50. So if the call side was starting to shake a little bit, then I would want to at least buy it back for less than 150 to make profit. Otherwise, I'm not just looking to make profit by selling the whole structure. Even if I receive $3.30, I don't just want to sell it for $2.50 without understanding which side is actually the moneymaker. In fact, if I sell it buy back for $2.50, one of them might be going to expire worthless. So let's see what the other side actually did. So on the put side, again, I want to subtract the long from the short. So 1235 minus 1055 gives me 180. Right. So now you know how to get the price of each side of the condo. So if you add 180 and 150, that ought to give you $3.30. Does that help over there, Anthony? Or anybody else who did not know how to understand what your position statement looks like when you sell an iron condo? So
Understood.
yeah, so that's the way to do it. And then obviously when you want to close it, simply go here, create closing order. And the thing about here is that you've got so many choices. Yeah, you've got about 10 choices. I didn't even count. I don't know how many of these are, but you can buy back the whole condo to close it. Right now it's at 335, which obviously is not good because we know we sold it for what,
330.
330, right?
Right.
So when you're selecting which ones to close over here, you have to be very, very picky, right? And notice that we do have the vertical, right? We have one vertical here, which is the call side, and we have the other vertical here on the put side. So this one says 185, and that was the calls, but we know that we sold it for 180, so that's not good. This one is at 150. Again, that's a break even.
Break even.
Yeah, it's a break even. So you might decide when you're trying to close it, you want to make sure that you close the correct one. Sometimes this is a little difficult if you have multiple positions open for that same ticker because they're going to show up over here. The way that I like to do it myself is I like to be very, very explicit. I will come back over here and create a buy position and say buy, just buy the vertical here. And this is the one I probably close for 180, I think. So I'm going to just close it for say 60 cents. How about that? 0.60. And this ought to create a closing order, even though it says just buy, you're entering the position. If I push send on this one, it is going to create a closing order on that side of the iron condor. So you can do that. This is different from if you just open a vertical and try to close the short legs. And people have tried that with disastrous results. You never ever want to do that. Let me switch cameras here for a second. Give me see what's happening here. I want to do this. I want to do that. You still see me? You can't see me. My camera was a little dark over there, so let me hear about that. I think that's much better. Yeah, that's much better. Right. Cool. So let's see. Questions on that, Condor? It's an advanced strategy. Not so many people might be familiar with it, but let's see. Let's welcome Mia. Let's welcome Markinet. I wonder if I say that right. And the Christophers. How about that? We've got Doreen and Timothy. Welcome.
Morning, Eddie.
What's happening, Doreen?
Oh, not much.
Cool. Cool. Yeah, we're talking about iron condors today and seeing how that might even be a strategy for us. So, yeah, that one is the structure of an iron condor takes advantage of number one, buying power efficiency, right? I call it capital efficiency or buying power efficiency because the amount of buying power that you need for an iron condor is actually based on the longest side, right? Longest wing. So in this particular instance where we did both a PCS and a CCS, they're both 5-point wide spreads. So you only need buying power for one side. You might think that you need 1,000, but in fact, you only need buying power for one side. The theory here is, or the thesis is that if you let these go all the way to expiration, only one of them can win. They cannot both win or they cannot both lose, right? I guess both can win. Let me say that properly. They can both win by expiring out of the money, meaning that price ends up in the middle of the condors, right? Of those spreads. They cannot both lose because price cannot be in both directions at the same time.
Right.
Makes sense? Yeah. So it's also a defined strategy. The risk here usually is the width of the spread. 500 if it's a 5-point wide spread minus the premium that you received. So in this particular instance, this is actually a good spread because guess what? If I sold this spread for $3.30 and it expired on one side in the money, right? What would you do there, Anthony? What would you do? Let's say it's five. You collected $3.30, right?
All right.
And one side goes, bust. It traverses one side. Doesn't matter which side. Yeah. And it's fully in the money at expiration. What would your loss situation look like? Is it crazy? Is it bad?
You said one side.
One side expires in the money, the other one obviously out of the money.
I would get, I think from your description, I didn't spend. I would lose 330 and get 170.
Actually, it's because it's a credit spread. You received 330, so that one is in your pocket no matter what.
Right, but then I lose the 5.
Yes, you lose $5, so it would be 5 minus 330. So your net loss
170.
So your net loss would be 170. So let's see how that would work. So the broker would actually take 170 out of your account at, once everything is settled. But since you already received $3.30, let's take a look to see what your net loss would be. And that would be $1.60.
60.
Yep. $1.60. So if it were me and I got challenged on a spread like this one that I got that went bust on one side, I really wouldn't fret. I wouldn't care so much. And that's why people love iron condos, because even if it goes bust, for as long as you received really healthy credit, like we did in this case for $3.30, then you're good, right? The
Right.
max loss or the net loss, actually here it's a net profit situation. Becomes a net.
What I was gonna ask you, Eddie. I
Mhm.
don't want to interrupt your flow, but
Sure.
what is like a good credit to be received? Because I know if you ended up taking some strikes that are further
Mhm.
away from the price, with a higher probability of success on both legs for your iron condor. Do you ever target like, if I could get $1 if I went out another 20 points on both sides? Is that something that you would consider, or is that too little of a credit for an iron condor?
It's not too little. It just depends on your trading plan. I have sold condos for 25 cents, believe it or not, right? But the risk reward is not in my favor if you do that. So let's break it down. If one side actually went to expiration in the money, you need to consider that will it offset that total loss to where you come up ahead. So you have to have that break-even point and say that uh, if after everything is done, do I have a net profit or net loss? If it's a net profit and it's decent, then you're good. But I wouldn't fret so much about maybe that extra 10 or 20 cents. Yeah, maybe you could if you're trading multiple contracts, but what I would probably avoid doing is selling for low money, right? If it's an iron condo, I really want that $1.50, $2 premium. Yeah.
That
And
makes a
then,
lot of sense.
yeah, $1 or $2 premium. Actually, even over $2 is preferable because you have both sides. If it's just one vertical, one PCS, we're usually going for about $1 anyway, right? Yeah, we're usually going for about $1. And so if now you've got a PCS and a CCS, then you can add 50 cents to 75 cents or even $1 to the other side. Because guess what? When you're getting premium of about $1 on one side, the other side has no money at all, right? You're already too far from that side, so you're more than likely going to be picking up an extra maybe 30 or 40 cents if it's early in the day, and then your winning leg will be where price is moving away from. So very cool.
Have you so in terms of have you ever employed strategies like max pain or max pain theory to figure out uh, where you want your iron condor legs to be? Is that a consideration factor, or are you mainly doing the expected move on both sides and using that for your leg?
Yeah, well, let's preface the study that you're referring to, or the formula is I'm not familiar with it, but they almost all use expected move. They also use volume profile, which is a key indicator of where price is going to move. So where there's more volume, usually that's where price is going to. It usually indicates either people are buying there a lot or they're selling there a lot. Either way, price is moving towards that direction wherever the volume is. That's where the market is. If there's no activity, let's say at I'm just going to use this example. If there's no activity at the 40, 45 level, price is not going to move this way. Doesn't matter whether it's selling or buying. Yeah. So I'm not familiar with that strategy, but I do use expected move quite a bit to give me a general guidance of where price is not going to go. That's the That's the main thing where price is not going to go. Out of all my trading credit spreads, I have found that using that IV, especially the IV, helps me a lot.
Yeah.
It does help me a lot in terms of trying to figure out where price is not going to go, except on days where we have like FOMC activity, in which case on those days indicators kind of stop working.
Yeah.
So the IV, expected move, those kind of things are what I use and have used successfully, in addition to the trend on the charts to help me sell.
One last question. You mentioned volume,
Mm-hmm.
and I was just kind of curious how you're able to see
Mm-hmm.
the volume. Is that a charting thing, or is there another? I've heard like, okay.
Yeah, you do have to use a third-party utility to get the volume, because by default you don't see volume on SPX, on S&P 500. So instead you have to use volume on either another metric. Now, this is advanced technology here where you might correlate the volume on SPY or volume on NQ or something else to relate to what's happening on S&P. So we know that S&P follows ES, which is the S&P E mini futures, and you can get volume on that. If there's volume on that, and you can see where the volume is on ES, you might be able to, let me see whether I can. I don't have it enabled here. Okay, you might be able to see where price is moving to. And usually those are short term, so you'd go hour by hour, but sometimes you do see volume at the end of the day, in which case then you can make a really quick decision if you get that intel real quick. It's called the market on close data. So.
Market, you said market of close?
Market on close.
Market.
MOC. I don't know whether you've ever tried to do an order and there's this little thing here instead of limit.
Oh yeah.
You've got the market on close. Usually that's when large orders come in. Like say somebody's selling 1 million contracts or buying 1 million contracts. That's market on close. If they try to do that during the day, that would throw everything off. So the brokers try not to allow that. They discourage that a bit.
Okay.
Mm-hmm. Cool.
So sorry, Eddie.
That's okay.
Got me really intrigued here with the specifically a third party. Is there any specific third parties that you recommend that can potentially show, I mean, where the volume is or where the
there are. So I do teach that in class.
okay.
You see where I'm going with this?
I sure do.
Yeah. So yeah, I'm not gonna give you a $10,000 idea on a free
Yeah,
class.
no, I get it.
Yeah. So, but yeah, there are plenty of tools that show you volume, and again, it's speculative. It's not always accurate because there's the billions of transactions happening, and 500,000 of them could sway the market one way or another. Yeah. So this is just to help out. Otherwise, if we had this kind of tools that help us without a doubt to tell us where price is going to go with the certain amount of accuracy, then the trading would be lopsided. Just a few of us would be trading, those who have those tools, right? Yeah. Cool. Let's see what else is happening. We've got Patricia who's online now. We've got Clarence. Hey Clarence, how you doing? And we've got Erica. Welcome. Cool. Yeah, today I think it was just a short Q&A session, not too much happening. Let's see, who else has a question that we can tackle real quick?
I have a question, Eddie.
Yeah.
Have you ever done, which you probably have, a naked put or call? I mean, in opposed to the vertical.
All right, you broke up there a little bit, but you said naked puts. Have I done naked puts?
Yeah, or
No.
calls.
Or naked puts or calls? No, I don't.
Yeah.
Even though my account is enabled for naked puts and naked calls, that is one heck of a dangerous situation. So the thing about naked puts or calls is that, sorry, yeah, and this is only when you're selling. I should clarify that. When you're selling premium, let's say you go into a situation where you just want to, actually, I'm just going to go to spread single here. And let's say I theorized that I don't think price is going to go all the way to 50.35. I could go in and sell, right? I could go in and sell just that one for about 14.50. But the capital requirement on this is actually 5035, which is the strike times 100. So my capital requirement over here would be approximately $503,500. So not a great idea. If I were to do a naked call, naked call or naked put, I probably would not do it on SPX. I might go for maybe something like Apple or something less expensive that I can afford. But generally, I wouldn't do that.
Sorry, so that's selling.
Mhm.
What about buying them?
Buying them, we buy them every day. Everybody does that. So buying a call, anybody can do that. That's no big deal. You don't have to use a spread. So here, for example, if I decided I was bullish on Apple and I felt that Apple, even within the next, let's say 23 days, would go up, then I would be able to sell for $3.60, which is actually $360 in real money. Not a big deal. My maximum loss here is the 360. Right? So here you're buying, which is very different from selling. Yeah. So also to clarify the difference between the buying and the selling, why is there such a huge difference? When we're buying a call, let's talk about calls to start with. We are bullish and we're saying that we believe the price of the underlying is going to go up. So the strategy to take advantage of that is to buy a call contract. You with me on that, Timothy? That's a simple case scenario. We can also theorize and say that if we believe that the price is not going to, say, reach a particular point, say in this case 173 over a given period of time, we could sell a call, right? So here we're selling a call and it's going to be either out of the money or something. Let's see. When we're selling, we sell out of the money. So we might sell out of the money at 180 or 190 or 195. Let's go with 190. I might sell these 24 May for 57 cents, which would give me $57, right? And the thesis there is that price is not going to reach $190, which is way up here, right? In those 23 days that I'm playing with. And at that point, that strike would expire out of the money. Then you get to keep 100% of what you collected. That would be a naked call. Most brokers won't let you do that. They'll let you do that if you have, maybe about $1 million and over in your account, and you have some demonstrated experience doing that, because these are risky deals.
Okay.
Yeah.
So there's a difference between, I guess I got confused, the single versus naked. So naked is when you're selling and you're expecting price not to reach a certain level, either on the call or put side. Is that correct?
That is correct. When we say naked, we are usually referring to selling a position. Otherwise, a single refers to just buying a call, buying a put.
Okay.
Yeah. So you could also sell on the put side. Put side here now the thesis would be negated. It would be the other side. We'll be saying that we don't think price is going to go below a certain point. In which case, then I would look at the chart and say, you know what, I don't think prices this is up here, right? So let's say I think price is going to remain above 164, which is the current support level at the moment. Say I decide I don't think it's going to reach 160, right? So in that particular scenario, if I was to go naked, I would sell the 150 strike, right? So if I sell the 150 strike, collect 46 cents or $46, then my thesis here is that by May 24th, which is when this contract expires, I don't think price will go down to 150. So if my thesis is correct, I get to keep that 46 cents. Yeah. Because most people cannot sell naked, that is why we do spreads. And so if I wanted to really take advantage of these, then what I would have to do is I would have to actually buy maybe the 145 contract. So now I received a less credit, but I've got insurance. So I've got the one call that was formerly naked is now covered by the 145 strike, right? It's now covered by the 145 strike. So it's no longer naked put. It's now a spread. Yeah.
And so do you ever do 0 DTE single calls if you're very positive, or calls or puts single if you're positive in a certain direction?
I do that. I try to avoid them these days because of the high volatility of S&P. So you know that S&P moves like at about 100 miles a minute. Yeah. So that thing can change direction and it's so fast. If you can take advantage, that's good. And I've done that many times. In fact, almost several years of trading 0 DTE calls. That's what I've done. But I've discovered I have better success using spreads when I define the risk. So as a businessman, what you want to do is you want to define that risk. You know how to then make the money. You also want to protect that money. So there's a high success rate on spreads than on single calls and puts. In fact, in the spectrum of risk, single call, single puts have a higher risk, much higher risk than spreads. So I prefer defined risk, defined profit.
That makes a lot of sense. Thank you.
Sure. Yep. And of course, if you're selling premium, you want to sell 0 DTE, right? If you're buying premium, if you're buying to get into a position, then you want to give it as much time as necessary. If it's an index, I'm usually going 14 to 21 days. If it is equity, then I'm usually going 45 to 90 days. Yeah.
Thank you.
Cool. Nice questions there. Yeah.
Say, Eddie.
Hey, what's up?
Let's say you are doing either a call credit spread on SPX,
yep,
or put credit spread on SPX. What do you do to get more premium, but still not be that close to current price? Because on my spreads, I'm getting in and I'm getting premium, but it's not the premium that I'm looking for.
Okay. So there's so many factors that determine how much premium. For instance, if we have a high volatility environment, which is measured by the VIX. So if you have a high VIX, like a few days ago, you will tend to get a bigger premium, $1, $1.20, $1.50. In fact, just the other day as a group, we did a spread and picked up $1.50, which appeared to be crazy, but to me it wasn't crazy because it was possible first and foremost, and we did get it. You can, to get the higher premium, either go early in the morning when there's higher volatility, That's number one. But you have to be very good at determining the general direction for the rest of the day, right? So you pick up the high premium, which is usually going to be, moderate distance from the money. That's number one. So you have a good thesis and you stick with it. Obviously you're going to have a lot more data than just what the price is. So there's plenty of stuff that you're going to look at. You've looked at futures, you've looked at volume profile, you've looked at what else is happening that day. Maybe no announcements, no federal, talks or anything like that. That's number one. Second is if you have a good idea where the price is going to trend. Now, we make our decisions on the daily, right? So
Right.
let me move here to the chat. So actually, I don't need this. Or maybe do I? I don't know. What did I just cancel? All right. So we make our decisions on the daily time frame, and we want to plot and see where is our resistance, where is our support, and if we're following a certain trend, even though this is 0 DTE, we tend to move towards that longer time perspective. So if I felt, I'm going to go over here to the 15 again. This is because we are a day trader here. You're probably trading on the lower time frames. Lower time frames to me is 15-minute, right? Sometimes the 5-minute, but 15-minute in general. So if I felt that I don't think we're going to go down or the price of the underlying is not going to reduce further, then I might wait for it to get to a downtrend and see as far or as close as it can get to what I will consider the low of the day, right? So I want to see how low is it going to get. And of course, I will have plotted my chart to make sure that it may or may not break, the support. So as close to as we get to support, then at that time I will sell the PCS, right? I'd sell the PCS
when it's close to the support, or when it's
absolutely.
going, or when it's like bouncing off of support and going back the other way.
Actually, around that time, I want to sell it as it approaches support, understanding that it is going to hit that support and bounce back. Right. So you have to be really good at your charting to understand that that's the likelihood of happening, and get as much premium as you can so that if things go bad, then you can get out quickly without, taking a hit.
Oh, okay.
Yeah.
That is okay. I got you.
Without taking a hit. So it means that if you sell it for 150 and now, the done thing is at 170, get out of it. Right. Don't even wait to go to $2. Just go ahead and give them that 20 cents and get out. But if it hits that 150 and usually it's going to bounce right back, right? We've demonstrated that a lot of times. If you've got your charting right and we've got these levels, it's within your expected move, it's within your IV range, it's going to hit that. I don't sweat, don't break a sweat. It's going to go right back up, and then vice versa on the higher side, on the top side for CCS, you do the same thing. As it approaches the higher level or the high of the day, then that's when you sell.
That explains it.
Yep. So again, it takes patience and it takes practice. And
well, I'm getting the practice in.
Yeah.
I'm getting the practice in, but
yeah.
I have no patience.
Yeah.
I'm working on that one.
You need both. You need both. There's a sale on patience coming up on Target.
Thanks, Eddie.
Yeah, you're welcome. You're welcome. Yep. So if you're new to this crowd, you notice we do a lot of spreads. We like spreads just because they are they're mostly they're defined, right? You know how much your maximum profit is going in. That's why we hear Anthony talking about how do I get the most, because that's the maximum that he will get on that particular position. You cannot get any more unless you roll the trade, right? Unless you roll the trade, and I don't recommend rolling the trade, right? Rolling is where your position is challenged and you decide instead of closing for a loss, you're going to close it, you're going to roll that position, and either collect more premium or pay a small debit. If you're going to pay a small debit, just go ahead and take the loss, close that position. If you're going to roll for a credit, which is the preferred, it means that in a credit situation, the short leg has not been breached, right? That just basically means price has not gone all the way up to that short leg. And if you believe that this, it's a temporary situation, not going to be resolved today, then you can roll it to either the next day or several days, or you can even do a vertical roll if you wanted to. But I'm not a huge fan of that defensive strategy. Got about a 50-50 success rate, 50% win, 50% loss. And usually when you lose big. You lose big because you just worsened the situation instead of improving it. So, cool. All right. Let's see. Everybody good? Good. Zoom has a new interface. I like it. Cool.
I have one question for you, Eddie.
Yep.
I I've noticed a correlation between red folders in the morning at 8:30 and then big moves on SPX right at market open. And I was curious if you have ever, since we were talking about iron condors earlier, have you ever bought an iron condor where the idea is if there is a big move towards one of your legs on either side, as long as there's a big move, you profit?
Yeah, I think an iron condor would probably not be the correct strategy for that.
Oh, instead of selling, I'm sorry, I didn't clarify. My apologies. Instead of selling one, buying one.
Yeah, you can. Yeah, you could buy one, but I think the best strategy for that would not even be a long condor. It would be a short. Sorry, it would be a long straddle. Yeah, you might want to consider a long straddle, which basically, let me see if I can demonstrate that here real quick. So here your thesis would be that, if you believe that price is going to be very aggressive on one side and not so aggressive on the other one, then, and you don't know which side it is, right? You don't know which side it is. So here, what I would do is, go ahead and fix these. There we go. All right. So I would pick delta. Usually when you do a straddle, you might go for delta 30 or delta 40, something like that. Or you might just do at the money. So if I did it at the money, I have a higher probability of success. So, and this is this is also a very expensive affair. So I'm going to buy the call here, right? The 50-25 call. I'm also going to buy the 50-25 put. So this is effectively a straddle, right? I said strangle earlier. This is a straddle. So a straddle here is saying that in order for me to make profit on these, one side would need to do extremely well, right? And then the other one would just either just go down to zero or something like that. But if price remained at that particular point, you end up losing 100%. You will end up losing. You can reduce that by going with a strangle. This is a straddle, by the way, right? So a strangle. Let's say we decided we were going to go with a delta 38 on this side, and we're going to do the same thing, delta 30, all right, 36 is close enough. So now you're paying less. You notice that you're paying less, 35.40 on this strangle as opposed to the straddle, right? The straddle was right at the money, both strikes on the call side and on the put side. Strangle, you still have a call and a put, but now they are, like kind of step. And ideally, you want them with the same amount of delta, give or take a few cents. So this one has a delta of 38. This one has a delta of 36. To make money on this one, you need one side to perform extremely well, probably get these 36 delta all the way to about 70 delta, right? Or 72 delta. Meanwhile, this one obviously is going to go to trash, right?
Yeah.
You can't win on both sides, but one side has to move, or this one needs to go all the way to like 60, 70 delta, preferably. It has to go twice what this one is, right? Price needs to move this one into the money, go to 50. At 50, it's going to be delta 50, right? Right. And to get to another 20 plus delta, you need another maybe 20 or 30 points. So you might have to go to 60 or 70 in terms of the price, 5060, 5070.
Okay.
So one side needs to offset. Now, if you sold an iron condor, you're going to lose if it's going to be a big move, because you're breaking the rules of an iron condor. The iron condor rule is that price is going to remain inside a particular channel, right?
Right.
Yeah. Yeah. I can't see your head shaking, but I'm pretty sure it is. So your condor has to, or price has to remain inside of that channel of the condor. If it goes outside those boundaries, you're definitely losing money. So
Right.
the news at 8:30 is great, and you will see the spike, but that's not the point. That's not the time to draw your pin. So it's called pinning your condor. Have you heard of that term?
You said pinning your condor?
Yes. So pinning your condor means that you're pinning the strike where you think that the center of your condor is going to be, or your iron fly. So it might be called an iron condor. It might be called an iron fly. Most, the system calls it a condor, but it might be a fly. So once you get the correct pin, and that only happens once the market is open, not before, then you can sell your condor. And if you're pretty good at that math, then hopefully that's something that can decay quickly. With an iron condor, by the way, or an iron fly, the idea is to get out within about 30 to 45 minutes.
Oh.
If you're still in it for about an hour and a half, you're losing money. Yes, you should be looking for a way to get out. You shouldn't be there all day.
Oh, okay.
So that's a strategy that works in a very, very short space of time. And again, I'm skipping a whole lot of semantics on this trade, because you have to also look at things like, and I lost my train of thought there. Volatility, right? It's a high volatility trade going in, and you're depending on the volatility shrinking significantly, which reduces the premium and the value of the spreads, and then you can buy to close at a lower price. A lot of words over there, but that is a concept that I usually take about 45 minutes to an hour to explain.
Understood.
So, yeah. All right.
Thank you.
Cool. No problem. Let's see. So what's McKinnon up to? You all right over there? All right. Patricia, you got anything? Erica? Deborah? What's up, Deborah? Good to go. All right. All right, guys. Well, I wish you a very happy Saturday, and we'll see you soon.
Thanks, Eddie.
All right.
Have a great one.
Thank you.